Ladies and gentlemen, welcome to the Q4 FY2024 results conference call of Senco Gold Limited, hosted by Emkay Global Financial Services. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Devanshu Bansal from Emkay Global Financial Services. Thank you, and over to you, sir.
Yes, hi. Good morning, everyone. I would like to welcome the management team of Senco Gold and thank them for this opportunity. We have with us today Mr. Suvankar Sen, Managing Director and Chief Executive Officer, and Mr. Sanjay Banka, Chief Financial Officer of Senco Gold. I shall now hand over the call to the management team for the opening remarks. Over to you, sir.
Yes, good morning, everyone. It's always a great pleasure to interact with all of you. We have, this is our first year in which post our listing, we are sharing our, thoughts, emotions, and the data regarding the way our company and our team have performed in the last financial year, FY2023-24. And I would say that this year has been a milestone year, a wonderful year, a journey for Senco Gold and Diamond. If we really look back the way it's been in the month of July, we got our company listed, and we've had one of the I would say amongst the best ever listing in the jewelry industry. The ability for us as a company to create wealth for so many shareholders and stakeholders with the performance of our company gives us a lot of happiness, and it is a privilege to be a part of the shareholding of the wealth creation for the for the various shareholders of our country. If we look at it, that how this year has been, it's been a year of doing many, many new things. We were amongst the first to have launched a metaverse platform with the future in mind of the way retail could be, taking small steps towards that. We got ourselves enlisted in the ONGC, which was an initiative by the government to make sure that we can reach further into the tier 2, 3, 4 towns and cities. We tied up with eBay to, get ourselves accessible to the world market, because with the Make in India and with the whole focus that India as a growing economy has to take a center stage in the world, it is our initiative to reach out to the various marketplaces across the world. If we look at in terms of our geographic presence, we've used this year to enter into the central India market with our store openings in Bhopal and Indore. We already had stores in Raipur. We opened one more store there. So now, if we look at it in terms of our total store count, as we ended the year FY23-24, we had 159 stores. The new number of stores that we opened were about 23, out of which 17 were company-owned, company-operated, and 6 were franchisees. The franchisees have been more focused on the Eastern India expansion, while our journey of opening new stores, building the brand, getting our awareness levels high across the country has been focused on East, North, and Center. We opened one store in South in Bangalore as well, and one store in Pune. So that has been a very balanced approach in terms of our expansion with a focus on Eastern and Northern part of the country. If we look at the various, products that we've launched, so last year we also took the initiative of launching a new brand, or rather a sub-brand called Siness, which was focusing on lab-grown diamonds and leather accessories. And we have started our pilot project by opening 3 stores in Calcutta, and we have placed our products also in the various stores of ours and in Chandigarh and Delhi as well, testing the market, looking at the way the consumers are behaving. In terms of the designs, in terms of the collections that we've launched, last year we've launched 23 collections across the year, be it in the lightweight jewelry category, in diamond jewelry category. So every month, we target ourselves to bring in new designs for the consumers, and that has been one of our focus areas, so that there is an inquisitiveness and inspiration for the customers to keep coming back to the stores. If we come down to the numbers, we will have seen that the revenue from operations overall has grown by 28.5%. Out of that, if we look at the retail business growth, we have grown by about 25%. If we see the PAT growth that we have seen, it has grown by 14.2% at a figure of 181 crores vis-a-vis 158 crores in the previous financial year. And our top line also has been 5,240 crores approximately compared to 4,077 crores in the previous financial year. So the effort and the endeavor that our team has done in order to grow the business has been, by all of your support, been in the right direction. If you look at the number of customers that has transacted with us, it's been about 588,000 customers, out of which we have seen that approximately the new customer base that has been a part of our journey has been around 288,000, and the remaining odd customers that have been there have been your old customers that have come back. So that is where we have seen, in terms of an interesting figure, we have seen that our old gold exchange with our customers has grown substantially. 2 years back, it was about 22% of the overall business was old gold, but today we see 32% of the overall business is happening through the exchange of old gold. Now that gives a kind of I would say signal that yes, one is the hallmarking policies that are being taken by the government is working in the right direction. Consumers are much more aware of the brand, aware of all the established brands, of the fact that they need to buy jewelry which is of the right purity, of the right standards, and they are utilizing it to exchange their old jewelry and buying new jewelry. And that is a part in which we are seeing the shift from the unorganized to the organized sector. Now, if we look at the stud ratio, we will see that, in terms of the diamond jewelry sales, we have grown by about 37%. And that's been a very decent jump in terms of the growth of the stud ratio. So it was 10.4% as the overall sale in the previous financial year. Compared to that, it's grown by 100 basis points to 11.4%. So there has been a constant effort and an endeavor on our part to take these new designs and collections to the consumers. And we have seen that because the gold prices, if you really observe the way it has worked out in the previous financial year, which it has moved from 57,000 rupees approximately in the beginning of the year to about 67,000 rupees by the end of the year. While the jump has been more so in the month of March, but till about January, February, it was in the range of 60,000 to 62,000 rupees. So that big jump is impacting the consumer behavior in what ways? One is that for the lighter jewelry, for the everyday wear, people are shifting to the diamond-studded jewelry or platinum jewelry, and that is why we are seeing that in that segment we are having a higher sales of the diamond jewelry. That is one. And in the second way to look at it is that as far as wedding jewelry is concerned, we are seeing in terms of the ATV or the value of the wedding jewelry sales, because of the gold price rise and because the fact is it is a necessity. The family has to buy jewelry for the wedding purpose, for the bride. So there, the stickiness and the inelasticity of demand, even though the prices have been on the upward trend, has been seen. And even if we look at the trend in the last 2 months with a big jump in the gold prices, it is this wedding jewelry collection and the wedding jewelry purchases that is showing a bigger traction compared to the lighter jewelry sales. So that is how we are, observing the market. And in terms of EBITDA, if we look at the numbers, we have grown by 18.6%. Almost it's been 8.2% is the Q4. 7.7% is the Q4 that we got the EBITDA percentage for this financial year, which has come down from the previous financial year of 8.2%. But our effort overall in the EBITDA level in the annual basis has been 7.3%, and we will be working towards ways and means on how we can take it closer to 8%. That will be our constant endeavor. Yes, with all the good things that's happening, where are the challenges or where we need to focus on? We have seen that our margins are under pressure. And, while we are seeing an absolute increase in terms of our profitability, but in terms of our percentage ways, it has come down. Now, that is something we have to accept, the way the market is behaving. There is an endeavor of growth, of capturing new customers. So that is one part of the, way of looking at it positively. But the other part of it is that the competitive scenario is increasing. We have our fellow friends, fellow dwellers who are also working towards, trying to acquire new customers. And I think in that competitive scenario, there are more offers and discounts and aggressive campaigns that are happening, and that is what is leading to this whole, downward pressure on the margins. But I believe that, this will continue as much as the time we will be taking for the shift of unorganized to organized happening. But we should look at a long-term picture. We should look at the 10-year growth journey of our country. And as a brand, I think it is our responsibility to look into the future, to create your new customer base and be a little aggressive in terms of your expansion in a sustainable manner. And I believe that that is where we are taking this little bit of sacrifice on margins for a longer benefit. And our endeavor to keep on increasing our diamond jewelry sales will continue to happen, which will be able to mitigate a little bit in terms of the downward pressure that we will see on the margin. So with this, I would request Mr. Banka to say a few words.
Yeah, thank you very much, sir. Further to what you have said about the qualitative factors, I will quickly give a brief idea about the financial parameters. So as we said that EBITDA margin has been range bound, and our target is to keep it near 8 and above, and that's our target. Our debt equity ratio, that has been range bound. So debt equity ratio, and it has slightly improved from 1.24 to 1.09. This is based upon the free cash flow for the current year and the IPO funds which came and which has been used for the working capital. The toll on TOL upon TNW, which is an important parameter for credit rating, that has also improved from 1.7 to 1.42. The net debt to equity, which is a very important parameter to understand what is a net debt. So we have a FD margin of around 500 crore plus on account of hedging and collateral. So the net debt to equity has also improved from 0.79 to 0.70. Cash conversion cycle, that has been in the range bound of 165 to 169. The press release which we have issued, it has also highlighted some other important parameters. Particularly, we have to look at the finance cost from the Ind AS angle. So the finance cost which is visible in the financials, it includes a lease rental impact of 28 crore. So effectively, as you said, the finance cost is in the range of blended interest rate is around 6% on our total borrowing. Our EBIT margin has been stable at 6.8. So these are the few parameters. If I come to balance sheet, our net worth has increased from 949 crore to 1374 crore, a growth of 425 crore, primarily on account of equity and the PAT for the current year. Inventories have increased by 559 crore, from 1877 crore to 2436 crore. In this regard, it is important to understand that this inventory increase is slightly optical because it is not a quantity increase at all the stores. It is about the new stores which have been set up and the price increase, the 15% price increase. So that leads to an optical illusion of the inventory increase. But our inventory days has remained stable. It is 2.41x or around 151 days and among the best in the industry. Borrowing has slightly increased. So post the IPO funding, while we have used the IPO working capital, but since we have been working for the growth and since the gold price increase has happened, the borrowing has increased by 382 crore. A very important point is the free cash flow. So the accounting policy which we have adopted earlier, and since during the IPO we could not do the change in accounting policy, so optically the free cash flow looks negative. But if we adjust the gold metal loan borrowing, the GML borrowing, from the financing cash flow to operating cash flow, then the operating cash flow will become positive by 46.02 crores. So with that, we conclude our briefing on the business and the financials, and we invite your query. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Avnish Roy from Nuvama. Please go ahead.
Yeah, thanks and congrats on good numbers. My first question is, your Q4 revenue growth was much stronger than the 9-month growth. So what's driving this? Is this gold price store addition? And secondly, in FY25, after a weak Q1 in terms of wedding days, then the wedding days are actually picking up. So wanted to understand what will be your expectation of growth in FY25. Can it be faster than the growth in FY24, given exit rate has been very strong?
So the Q4 growth has been higher than the Q3 growth. Q3 growth is usually, you have Dhanteras, the festive season, so therefore the base is always on the higher side. And, one needs to look at the base and build on that base which is already high. For Q4, the wedding season, we had a large number of weddings up to 7th of March. So if we look at January and February months, we've had a very strong, performance and demand from the consumer end. Post middle of March, the numbers started moving a little downward, and that is where overall we've seen a little lower traction. But the first 2 months have been the maximum benefit in terms of the growth that we have seen, led by the wedding season. So that was one. And going forward for the coming financial year, if you look at the macroeconomic scenario, we've already had Akshay Tritiya, which is one of the bigger days of sales and a season for the jewelry industry. The gold prices have moved upward since March, and even in the month of April, it was in an upward trend and a curve. So that is impacting sales. So if you really ask, in terms of value, till Akshay Tritiya of about 15% but in terms of volume, we have not seen much of growth happening. So people are taking a little bit of time to get used to the gold prices. So in terms of our focus and our efforts, we will want to continue to grow at about 18 to 20% in terms of top line, and in the same way with our mix of gold versus diamond stud ratio and the other products, we will also want to ensure that our bottom line also grows approximately between 15 to 20%. So yes, the global uncertainties, the war, the gold price volatility, all of that put together, maybe the conservative estimate is 15% and the positive optimistic estimate will be about 20%. This is how we are looking at the picture.
If I add to this, basically, if you look at this 39%, so Q3 was 23%. One clear factor is the price variance of the gold price increase. So let's say if we exclude the 15% gold price increase, we are left with 24%. So there is a volume variance of around 13% as well. Then we have a volume, we have an increase of around 19% in diamond as well. So since there are around 36 new stores which have been set up in last 2 years, in March 24 and March 23. So there is a cumulative impact of the new stores coming up, which is usually in the second part of the year. So the price variance is one of the factors, around 15%. The volume variance of gold, SSG is almost, as you said, is around 18%, 20% for own store. It's a mix of all these things. Moreover, as the customer base is increasing, that is also creating a ripple effect.
Understood. My second question is, you have added 36 stores in last 2 years. So wanted to understand FY25-26, what will be your target? Second is, now you are going into some of the new markets where the brand is unknown and the local taste also will be different. So, for example, going into these cosmopolitan cities like Bangalore, Pune, are you targeting more of the East Indian population or maybe even the North Indian population? Is that the main focus, or is it you are going completely local from a Bangalore perspective, local from a Pune perspective, just full mass audience you are targeting? That's my question. And what is the response you have seen, say, in Bhopal, Indore, because that again is very new to the brand and definitely very competitive also.
So as far as the new stores are concerned, we are looking at about 8 to 10 company-owned, company-operated stores and 8 to 10 franchisees. These are the thought process with which we are working for the new financial year. So about adding between 15 to 20 odd stores in the coming year. So that is one. Second is that when we are entering these new, and we have said that before as well, that when we will be growing, our focus of growth, almost I would say 70 to 80% of our growth will continue to be Eastern and Northern India, because we want to continue to play on the economies of scale, and we want to leverage the brand and the goodwill that we have building upon in the Eastern and Northern part of the country. So that will continue to be our focus. Yes, other than that, be it West or South or Central would be a mixture of West and North, but the awareness levels are gradually building up. How do you build up awareness? When you open a store, as far as the product portfolio is concerned, usually our merchandisers are surveying the market, understanding the local taste, and being from the base being Calcutta, where the maximum karigars are based out of, manufacturing of jewelry of whichever part of the country is not really a big challenge. It is the brand awareness, the loyalty of the customer that we have to get over a period of time is where we need to work upon. So yes, Bhopal and Indore, it's just been less than a year. We are doing our marketing campaigns, we are building awareness, we are taking help of various local partners, marketing partners, trying to build those customer relationships. And as far as the product portfolio goes in, say, Bangalore or such cosmopolitan markets, we are aware where our strength lies. Our strength lies in Eastern and Northern part of the country. So when we are planning our merchandising with the cosmopolitan crowd in mind, when it comes to diamond jewelry, it is cutting across all communities, because it's for everyday wear, lightweight. We've been trying to be as design-oriented and value-oriented in terms of diamond jewelry. So that will cater to and very large customer base. When it comes to gold jewelry, we are consciously taking a 40-50% design portfolio for Eastern and Northern consumers and 40-50% for the local consumers. And accordingly, we are planning our merchandising. This is how we are looking at it.
Sure. Last quick question. So if you see the gold import data in terms of the quantum of gold in terms of tonnage, it clearly suggests that illegal gold is increasing and fairly significant. So that is one point. Second is the local jewelers clearly still do not hedge, and it doesn't make too much sense for them to in fact hedge because gold is going one way up. In that scenario, if you could comment, how is your company able to compete against the local competition? You are doing quite well, but still wanted to understand how big is that a problem. And second, there is some dip in gross and EBITDA margins, which you also highlighted. So when do you see the competitive intensity dipping? Will it be a function of the gold prices coming back to a bit more rational level? Till then, the competitive intensity, will it remain high?
So when it comes to the gold import data, we will see that if you look at the quantum imports in terms of tonnage, over the last 6-7 years, it has been in the range of 600 tons to 800 tons. There were 1 year where there was 1,000 odd tons. That was the post-COVID scenario. But other than that, on an average, it is around 700, 750. So whatever you see in terms of the market share and the consumption, it is a value that is growing more rather than the volume, and the shift from the unorganized to organized happening, where the organized players are having a bigger pie of the cake. That is the scenario that we are looking at. Now, in terms of the unauthorized gold, let me tell you that in spite of whatever data reports and all that is coming in, it is not easy for a normal jeweler to do much of business with the policy, with GST, with the vigilance and the monitoring mechanism of the government over a period of time. Even if anything like that is happening, it cannot sustain for a long period of time. So, and that will not be able to impact the bigger consuming centers, maybe in the far off some village or somewhere like that. It might still impact, but it will not impact the jewelry industry per se. It might impact the bullion industry. So that is how we would look at it. Yes, what is happening with the unorganized segment and the competition that is increasing is that when the organized segment is growing in a fast manner, the unorganized players are trying to survive, trying their level best to put their best foot forward, being more competitive, trying to build relationship with the consumer. And then it is a matter of design, service, how the organized players are being able to cater to the consumer demand. Finally, over the past, I think, coming 4-5 years, you will be able to see a consolidation happening, and this competitive scenario that we are seeing will much stabilize, and things will move upward in terms of capturing market share more and more. And even I would say, profitability is when there is competition, there will always be people trying to grab a higher market share. But I would say more stable profitability rather than growing profitability in the coming after 4-5 years. This is how one has to look at it.
Sure, thanks. That's all from my side. Thank you.
Thank you. The next question is from the line of Vidisha Sheth from Ambit Capital. Please go ahead.
Hi, thank you for the opportunity. My first question was on our northern region. Can you share an update on performance of your north stores in terms of revenue throughput or margins vis-a-vis at east stores? And what is your sense as to how can we improve the profitability in these stores going forward?
See, Vidisha, we don't speak about the profitability zone-wise, right? That is not published. But to give you a flavor, out of total 159 stores, we have 21 owned stores in North and 1 franchisee store, right? And in the last 2 years, the new stores which have been set up in the North are 4. Okay. Now, if you look at what we had highlighted last time as well, North is a crown. And since the North there is no leader, everybody is trying to capture and capture the market in North. So the stud ratio is highest in the North. So while we are talking about 11.4 blended stud ratio of own and franchisee, in North it is 17.2%. That is one I can inform you. Similarly, when we talk about the retail growth of 25% overall, right, which includes own store of, let's say, 26%, franchisee 22%, North growth is 22%, which includes SSG of 19%, which means that the North business is clearly growing. The average sale per store, while we have earlier talked about the blended average sale per store of around 35-36 crore, North average sale per store is in the range of 27 crore. So clearly the business has an opportunity in North, and in our future plan, while as you said earlier, East and North will be the focus, followed by West and South.
Sure.
So we continue to see opportunity of growth in North.
Sure. Second was on the export element. Given that higher revenue growth in 4Q was also a bit attributable to the exports, can you help with what is the ballpark export income for FY24 and 4Q FY24 and share your outlook on this segment? And sorry, just as a follow-up, how would its gross margins look like had it not been for the bump in this export income for the current quarter?
The gross margin would have been higher. See, export last year was around 70 crore to be precise. And this year we have done exports of around 187 to 188 crore. So as you are aware, export business gross margins are usually lower, let's say 6 to 7% range. So it has marginally diluted the gross margin. So in a top line of 5,200 crore, 187 crore and 6-7% on that does not really impact. So as you said earlier, the gross margin dilution is a function of the current competitive intensity in the market. You would have seen that the other large players are also facing this challenge. A lot of discounting is happening while we are avoiding the temptation to give more discount on the gold. Others are, I think, they are giving the discount. So we are on diamond also, the market is giving a discount which is more on the solitaire and the 30 cents plus. Sometimes we have to follow the market trends. And this is in line with our expectation for the current year.
Noted. And lastly, on the borrowing side, how much of the short-term borrowings of 1,500 crore is pertaining to gold metal loan, and what would be the amount of other working capital loans?
See, our borrowing as on March 24 is 1,497 crore. Entire borrowing is short-term. There is no long-term borrowing. I think there is only 4 or 5 crores because our borrowing, right. We don't have taken any borrowing for the plant and machinery.
Right.
Gold metal loans should be around 55%, around 700 to 800 crore would be gold metal loan. And the interest rate, as we have said in the earlier Concall and the quarterly presentation, our rate of interest on the gold metal loan will vary from 3.2 to 3.78, and on the working capital facility, that is CCW, CDL, etc., it will be around 9.5. It's a blended of around 6%. And this is what we've said, that we look forward to increasing the GML percentage year on year. That's a part of our strategy to minimize the cost and pass on the maximum benefit to the PAT and to the shareholders.
Got it. That's all from my side. Come back.
Thank you. The next question is from the line of Devansh Nigotia from Safe Enterprises. Please go ahead.
Yeah, so thanks for the opportunity and congratulations on decent numbers. First, one is with respect to the inventory build-up which has happened in this year. Is significantly higher than our peers with similar store expansion and on percentage basis, while the gold price increase has been pretty much similar for all of us. So can you share some thoughts over there? And also, if you can break up the inventory build-up between the price increase and between the investment which has happened in our COCO stores. So that would be really helpful. And where do you expect it to rationalize also by the end of FY25 or maybe H2 of next year?
Right.
FY25.
As you said in the press release, at a summary level, the inventory increase is seen optically because the gold price has increased by 15%. So a major reason for that is due to the gold price rise. So while we have added 16, 17 stores, so increment, let's say our total gold inventory, I'm quoting the figure, was in terms of figure it was around 1877 crore, and this is around 2435 crore. In terms of kg, it has increased by only around 270 kg for the new stores.
Okay, and how much does that translate into the amount?
I'm the answer to you. And over last 6 years, so let's look at last 6 years. Last 6 years, it has only increased for 650 kg. So when we talk about average inventory per store, obviously stores are of different size. Average inventory per store is only 24 to 25 kg, which means the new store also has inventory of 24, 25 kg. and the growth is primarily for the price rise.
Okay. And so what is the outlook in terms of margin guidance for FY25?
The margin we have not said much. We have only said that the market is competitive intensity will further increase. And so in order to mitigate the competitive intensity, we will continue to work on our stud ratio strategy, increasing our stud ratio by 100 to 120, 30 basis points every year, which will mitigate the price pressure which will come on the gold business, and we look at around 20-30 basis points improvement in the gross margin and EBITDA. This is what is the conservative outlook we can give. So you would have seen the published results of other fellow jewelers. They have also seen this pressure on their gross margin, EBITDA and EBIT at all levels. Our advantage is that since we are a market leader in the East and we have a strategic locational advantage of being present in Calcutta, which is the largest supplier of karigars to India, the pressure on us is much lesser.
Okay. And so just last question, the interest portion which we mentioned, the GML portion which we will increase, so how, what is the optimum GML percentage we can take, or the limits that we have currently that can mitigate this high cost borrowing from banks?
See, we are looking at around 75% is optimum. I don't have the exact breakup of the competitor or the industry peers, but from our current level of around 55%, of the total, which was around 55% last year and has improved to 61% as of March 24, we propose to take it to around 75%. So that's
and this will be the maximum limit?
Yeah, so there is no maximum limit. It's a mix of so we have a consortium banking from around 15 bankers, and each and every bank has their own policy of the product mix and their margin mix. So it depends upon the negotiation. So I can't say it is maximum. We will try to maximize the value for our shareholders. That's what is our promise for the management team. So we continue to understand best practices from our fellow jewelers and consistently work for improving the value, be it at the gross margin level, EBITDA level, or at the finance cost level. That is what is our promise to our shareholders.
Thanks a lot, sir, for answering all questions. All the best.
Thank you.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Hi, Shivankar, Vankaji, good morning. Thanks for the opportunity and comments.
Good morning. Good morning to you. Good morning.
Sir, starting with, in your press briefing, you have given the ASP is 41,600. So I just what is this? Is full year number or this is quarter number? And maybe if you can tell me if it is quarter, what was the number last year?
So it is a full year number,
okay.
Which and ASP of 41,000 and ATV of our so ATV is average ticket value and ASP is average sale price of the unit that we are selling. So ATV is in the range of 75,000 and ASP is 41,000, and it's for the full year. Even if you look at quarter or full year, it is usually in the same range, 1,000 rupees here and there. So that is how one has to look at it.
So I will add one more point. What we have reported earlier, this ASP and ATV was at an overall level. So if you remember, one other player has also given the gold ASP separately. So if out of this total, our gold ASP is around 54,000 rupees. So 54,800, or let's say, so clearly the ASP overall has also seen an increase. So gold ASP is around 54,800. And the diamond ASP is 42,000. So blended is what you are saying. But gold ASP is 10,000 more, which will disclose in our quarterly presentation as well.
Okay. Bankaji, that's helpful. But what I wanted to check, I mean, in the context you have said the gold exchange has increased to 32%. So I just wanted to say, technically, if the ASP is going up, That's the comment. If you can also you can.
Yeah. So we have clearly said that the ASP is going up in all the categories, in the gold and in diamond particularly, because there is a premiumization happening. So as we are moving up the customer over the value chain, as we are moving into north and west, we are getting more and more premium customer. So while other players, and still despite we are moving up the value chain, there is still our ASP and ATV among the, I would say, moderate range. So premiumization, bringing more new customer, bringing more youngsters is what is leading to increase in the ASP.
Okay.
And this increase in ASP is not a function of price rise. That's what we want to clarify. It's a premium customer, youngsters, the lightweight jewelry, where our making charges are more due to our brand positioning.
Okay. So one follow-up here in the context of what you're saying. I don't know whether you measure that, but what is the new buyer growth or what is the contribution from new buyer growth, new buyer?
So the truth, I think CEO sir has just explained.
Yes.
Our new buyer number is around 51%, while the new buyer value.
So I'll tell you what. We had a total number of customers that transacted was 5,54,000, and out of that, the new customer was 2,72,000. So approximately 45 to 50%. That's how one has to look at it.
Sure.
And the repeat buyers was the remaining 2,80,000, so around 55%. So 47, 53, something of that sort. And this is also one has to look at the growth numbers that the repeat buyers last year has grown. So we tried to reach out to our existing customers and offer them new collections and designs, so we could win back many customers who haven't been buying for a year and a half. And the new customer growth rate is standard between 5 to 10%. So that's how we are acquiring new customers in terms of the growth every year on year.
That's really complimentary. I mean, it's really fantastic number. Hope you would continue on that. So the other question.
If I just compliment what sir has said,
okay.
Basically, loyalty customer is a stable customer base, which you've said earlier, 55 to 60%. So if we look at loyalty customer sale value, in terms of value, it is around 55% plus.
Right. So see, if you understand the category, you will understand that the consumer would want to, every year buy something or the other. Women as a customer, they get they get bored with, suppose, a design that they've been using for, say, 2 years, 3 years. So a lot of consumers having a higher disposable income will keep accumulating and buying new. And many consumers will want to exchange their old jewelry and buy their new design. So this is how the consumer is behaving, and we have to come up with new designs and collections to keep them excited and coming back to the store. So this is what we are trying to do. So very recently, as we speak today, we've launched our new bridal range collection for the season. And this is a trend that we have seen in the last 1.5 months during Akshaya Tritiya time also, that people having their weddings in the end of the year, like say November, December, because of the gold price rise, are already starting to accumulate their wedding jewelry. So we've already launched the wedding jewelry range. We're calling it the Gatbandhan collection in this time of the year, so that people can start accumulating their jewelry for the wedding, buying for the family. We also launched something called the Marigold collection. Now, maybe we will talk more in details after the Q1 performance. But these are initiatives that we are taking so that people can start planning. How do we solve the problem of consumers being able to buy jewelry with such high volatility in gold price? So we've launched the Marigold collection, Marigold scheme, in which consumers can keep accumulating their money, save it with us over a period of 6 months or 9 months, and then they can, buy it at the end of the tenure and there is a flexible option and a fixed option. So the fixed option, you can average out the gold rate based on your convenience, and the flexible option is in which at time of booking of gold and at the time of buying of the jewelry, whichever is the lower, the consumer shall be passed on the benefit. So we are trying to come up with such innovative offers and schemes to solve the problem of the high gold price for the consumer.
That's really helpful. And my last question on the Akshay Tritiya. So maybe if you say that you have clocked 19% SSG, how this SSG would have happened in last 40-45 days?
So in the last 40-45 days, if we look at the SSG numbers, we have grown by about 18%. But, like to like has been 12% and the new stores have been 6%. So total growth has been 18% for your company-owned, company-operated store. But if you look at the franchisee business, there we have seen that the growth for the franchisee has been a little higher. So this is also something that we are hoping and observing, that the franchisees, which are mostly in the tier 2, 3, 4 towns and semi-urban or semi-rural kind of areas, they are seeing some amount of higher traction, whatever be the case. So the rural India growth story is going to look very positive this year, hoping for a great monsoon. That will give us a good, response from the rural and the semi-urban market post Q2, I guess. So that's been the way. But what is the point to be noted here, along with the value growth numbers, is the volume growth has not been such because of the price rise. It's only been in I would say in the same range. No growth in volume, only growth in value.
Sure. Thank you, Shivakar, and all the best to you and the team.
Thank you.
Thank you. The next question is from the line of Mohit Mariwala from Envision Capital. Please go ahead.
Hello, sir. Good morning. Thank you for taking my questions, and congratulations on a really good set of numbers. So, sir, my first question is that out of the total consolidated revenue, what was the proportion of COCO stores and what was the proportion of your franchisee stores?
Proportion is usually
around, franchise. So out of the total, franchises should be around 35%, and the balance would be around 60 would be owned, balance would be export, e-commerce, etc.
Okay, so 60 owned, 35 franchise, and 5 export.
Yeah, export, e-commerce, corporate, etc. So we have a team which actually does B2B business with the corporates. We have e-commerce site. We've got DigiGold, we've got DigiSilver. So all the digital platform we are making future ready. So while current focus is very clearly on the brick and mortar model, but we are making ourselves ready for the future as well.
Okay, super, got it. And so if I had to see your cash flow statement, so basically the capex that was done in FY23 is 31 crores, and in FY24 it's 38 crores, versus COCO store additions of 5 stores added in FY23 and 16, 17 added in FY24. So there's a significant difference, on a per store basis, right? So I just wanted to understand, is this because we are taking more stores on lease? Is it because we are opening smaller stores? Is it because the real estate is cheaper in the newer locations? So I just wanted to understand how to kind of interpret this difference.
So basically what we have reported cash flow, in the accounts you will find, let's say one major store which was Hathibagan store, it was due to some issues, it was work in progress for 5 years. So the cost incurred was 17 crores. So you will see a higher number as far as the balance sheet is concerned. But as far as cash flow is concerned, we have said around 37-38 crores. That is one point. Clearly, so we take most of the stores on lease. We don't own the stores. If you talk at 90 total stores, only 7 to 8 are owned by the group company which we take on lease. So as a strategy, we don't invest in the real estate. We all know that real estate does not yield results, and we are working for giving the maximum return to our shareholders. So we don't own the stores. all the stores are taken on lease for a period from 7 years to 17, 18 years. Clearly, the capex, so average capex per store in terms of per square feet is around 6,000 to 7,000 per square feet. Now, as you've seen, we've got multiple models. We've got a Insignia model which is quite premium. We've recently launched House of Senco is quite premium. The old classic store cost is lesser. We are renovating that, so we have also modernized our store look and feel. So you see the Noida store has been modernized. The existing stores are getting modernized. So on an average, around 2.5 crore is the capex per store. There are stores where we have incurred 1.6 crore also. There are stores which have got so 1.6 and 1.2 and 2.5. There are multiple ranges, but average is around 6,000 per store per square feet.
Okay, got it. And so just to understand, for how long do you take these leases on the store, and what is the renewal kind of cycle like?
So it's usually a 9 years lease, and then we get it renewed. So usually it's a 9 years.
Okay, got it. And just a question on plans in the international market. So just want an update on how the store in Dubai is doing. Any further plans to expand out there? Just how the uptake has been out there.
So the store in Dubai has just got. We did the puja and the auspicious beginning on the day of Akshaya Tritiya.
Right.
So the store in Dubai is under, I would say, the initiatives, the plan, the consumer connect, all those things are under process, and it is right now nothing substantial to talk about. We are, taking the initiatives of building up the future traction. That is all that I can say. But yes, what is the long-term vision is that we have already our fellow jewelers that are either established in the global market or are endeavoring to grow in the global market. For us, there is like a three-phase strategy. One is the East and North strategy, the rest of India strategy, and the global strategy. And the immediate traction is the East and North. That will ensure that the profitability, the cash flow stays in hand. So West and South is the closer kind of time frame, and the global is where you have a limited focus and step by step you would want to grow. So this is how the priorities are taken.
Okay, great. And so just one last question. In terms of acquiring new customers in the new kind of locations that we are opening, what is the philosophy? So is it more on like you are offering discounts on making charges? Are you being aggressive in that context? Or is the idea to kind of spend more on advertisements, marketing, sales force, on that type of spend? So just want to understand the idea behind customer acquisition.
Right. So see, it's a blended mix strategy. Very honestly, two things has to be done. One is that the brand awareness has to go up. Yeah. Now, for the purpose of brand awareness, you will need to spend on marketing, which is outdoors, digital. People should get to know about the brand, the story about the brand, the Karigari story, the fact that we come from that place in the country, which is the hub for Karigars, the design, the fact that we can make products which are lighter in kind of weight and within the budget of the consumer, the fact that our diamond jewelry is value and can be really affordable. So those are the areas in which the brand awareness has to be built. But when it comes to these special occasions like Dhanteras, Akshaya Tritiya, or any of the local, hyper-local locations, there you cannot not give a discount. You have to give some kind of offer to the consumers to make them get hooked onto your brand. So at a 60-40 ratio, I would say brand awareness, brand building, and 40% is on offers and schemes.
Okay, great. That's it from my side. And
thank you. The next question is from the line of Vikrant Kashyap from Asian Market Securities. Please go ahead.
Hi, sir. Good morning, and congrats on a very strong set of numbers. I have a question on your store opening plan. Could you please break it up in terms of how many stores you are planning to open in your core strength area of North and East and how in other parts of India? And what would be the mix of company-owned and franchised stores?
So what I said is about 8 to 10 company-owned, company-operated, and 8 to 10 franchisees. That's the conservative estimate with which we are working on. And again, the focus of 60 to 70% of your store openings, be it own store or franchisee, will be eastern and northern part of the country, and 20% more so will be on the southern and western part of the country. So 70 to 80% eastern and north. Out of that, again, 40 to 50% is going to be east only, because we believe that there is still a scope in all the eastern India states of Bihar, Odisha, Bengal, Assam, Chhattisgarh, and further on to penetrate into the tier 2, 3, 4 towns and cities, or the growing fact of the capital cities of East India also. So therefore, we should not lose our focus on that. And North India, be it UP, Delhi, Punjab, all those states that are there, we will be focusing on those states for the thing. And then the rest is South and West, which we will go, with a lesser focus.
Okay, thank you, sir. And one question on your overseas expansion. Could you share your long-term vision, say for 3 to 5 years? What kind of opportunity you see in the overseas market, and which of the geographies you are targeting, and what kind of revenue net mix we will have?
Thank you for the question, because it's very important to have a long-term vision towards which one has to keep growing. So if you are aware of this report of Deloitte that had been published in the month of February, in which they were talking about the top 100 luxury brands of the world, and we spoke about this in the last earnings call, that there were 6 jewelers, 6 companies from India that were listed in that list, and out of that, all 6 of them were from the jewelry industry, and we were amongst one of those to have been listed. So with the Indian diaspora, or as we call the subcontinental diaspora, spreading all over the world, there is a market that is lying there to be tapped. And we already have our fellow jewelers who are, doing a great job of going there and capturing the market. So the brand India, made in India, jewelry designed in India, those kind of thought process is also something that we all need to talk to grow the economy. And I think we all have to play our roles and part in it. So yes, with the Indian diaspora in mind, and with, say, the subcontinental diaspora in mind, we would step by step. But again, it is not about how, it's all about capital allocation. It is all about balance. So not that a huge capital allocation will happen in the global expansion, but 5-6 years in the major areas in which already I think the market will be created by our fellow dwellers, we would like to capture a part of the market as and when the time would suit right.
Okay, great, sir. Thank you for answering my questions, and wish you best of luck.
Thank you very much.
Thank you. The next question is from the line of Ali Asghar Shakir from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity, sir. Couple of questions. One is on the growth. So you guided about 18-20% growth on an annual basis in 25. But for this quarter, you mentioned about 18% growth that you have observed, out of which 12% is LFL and about 6% is the growth from new store. Did I hear that correct? Follow-up there is that in terms of new store, given that, you will be adding about 18-20 stores, which is, a footprint growth of nearly about close to, 12% plus. So in the current quarter run rate seems to be higher than what you are guiding for the full year, given the improvement in prices. So that gives you a upward bias, correct?
See, Ali, sorry, we could not understand your query. If you can be specific. What we have said
Sure.
is that we have grown at a retail level for the full year at 25%, and SSG was 18%. That is one. And that as far as Akshaya Tritiya is concerned, overall we have grown 21% and own store 18% and SSG 12%.
Okay. So then basically for the quarter so far in the 45 days you have done about 18% SSG growth, right? So that in a way is way higher than what you are guiding for the full year of about 18% growth. So in that context, if the gold prices remain where they are, then certainly the growth in FY25 will be way higher than what we are guiding.
Slightly, I think the slight confusion. In the current year so far, we have grown around 20% plus. Own and franchisee both taken together, and SSG is around 12%. And earlier also we've said that the SSG is around 60 to 70% of the total growth. So if we grow 20%, SSG will be 60 to 70%. That is 12% to 13%. If we grow 30%, SSG will be 60 to 70%. That is 18% to 20%.
Got it. Second question is on the gross margin. So, you indicated that we would target to improve our margins to 18%. Having said that, given the fact that we are still seeing competition, being intense in the making charges, do you think that the increase in studded will fully offset this impact, or you think that, in the near term, we should continue to see impact on gross margin?
We are very happy that you are giving us such a nice number, but we have not said that the gross margin will be 18%. Our gross margin for the current year is around...
So we said that the EBITDA has grown for the full year by 18.6% from 316 crore in the previous financial year to 375 odd crore in the FY24 year. So that's been the growth of EBITDA. And our...
Sorry, I meant 8%. Sorry, I meant 8% EBITDA margin. Sorry.
8%.
Yeah, sorry.
So our EBITDA margin is at 7.3% that
Correct.
we have seen, and we will work on increasing it towards 8%. That's what we
Correct.
are saying that is going to be our endeavor.
Correct. But given the fact that we are seeing impact in making charges...
Yeah, so the impact on making charges, the impact on the gold rates and all of that will be the factors for the downward pressure. And for that, the increase in stud ratio, the increase of sales of more of diamond jewelry, that will be the one that will create the upward pressure. So that's where we need to work on increasing the stud ratio. And our stud ratio is 11.5% as on date. And you're all aware that our fellow friends have had a bigger share in terms of their stud ratio and the diamond jewelry sales. So, even if we do 100, 150 basis point jump in the stud ratio, that will create an upward pressure on the margins and the EBITDA.
Understood. So basically, you should be able to fully offset this impact of making charges and still improve your EBITDA margins.
That's the thought.
Got it. Okay, that's clear.
Thank you. Ladies and gentlemen, we'll take this as the last question, and I've handed the conference over to the management for closing comments.
Last question is over, or are we waiting for the last question?
No, sir. Last question is over.
Okay. So yes, thank you everyone for attending the earnings call, and we're very grateful to all of you for standing by and supporting the effort that we as a team are making. As I already said, that this year is a milestone year for the journey and for the team Senco Gold and Diamond. And while we all are working towards growing the business, there are challenges to be faced in terms of the gold price volatility. We've seen in the last 2 months the heat wave, and because of the election, there have been a little bit of lesser traction and movement comparatively. But we are all very optimistic that post I think June, we will be able to see a much more positive sentiment in the economy, praying for a great monsoon that will all impact the agricultural sector, which will in turn impact our jewelry business. The wedding season will be starting. The summer weddings are lesser in numbers, but it is still there. The winter wedding planning will all begin very soon. And with that positivity and optimism, we will continue to grow the new brands that we've launched, the new products and categories that we've launched. We look forward to consolidate on them and build those for the future, and hope to continue to interact with all of you and update you with whatever is happening in the jewelry industry. Thank you.
Thank you very much.
On behalf of MK Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.